All right, so I got to go over these four funds that can give you a 9.5% yearly dividend yield. Actually, it's insane. All right, so we talked about NCZ. So let's go back to NCZ real quick. And this is just freaking butt ugly, man. There's no other way around that. This is the Allianz Convertible Income Fund. And I showed you, let me just read this back to what I had. So if you had $100,000 invested when this guy first started, and you were back then getting 8.8% yield is what you got. You were getting $733 a month in income. All right, so back when it first came out, if we go to Max in 2003, you were getting $733 a month in income on a $100,000 investment. That's $8,800 a year. Divided by a $100,000 investment, and that's an 8.8% yield. Fast forward till today, that same portfolio, it would pay you $3,000 a year in income. Literally on the same investment, $3,000 a year in income, and it's only worth $25,000. All right, so you've lost 3/4 of your principal, and you've lost basically 2/3 of your income. That's just ugly, man. It's ugly. Now you could say, well, what if I buy it now? Okay, I don't know why you would do that, but whatever rocks the world. I mean, if we got a history, they give me fees on these things. What are the fees? I don't know why you would buy that. But you gotta do it. Let's see what the fees are on these guys. I mean, I know they charge. I don't know. They show the fees. Anyway, let's close that fund. They still got fees on it. All right. At this stage, I don't even care. So don't buy that. That's insane. Look, I don't necessarily fall for what it did in the past, but in this case, we got a significant steady decline on price per share, a significant steady decline on yield, on actually dividend that you're receiving. You've lost earnings, you've lost price, you're screwed. There's no other way around that. Why would you think it's going to be different now? It doesn't make sense. All right. So then we went on to, then I said, let's look at GBAB, and this looked better. And let me show you what GBAB is. This is the Build American Bonds Guggenheim Taxable Managed Duration Trust. And if we go to profile, I don't know why they don't have fees on these things. What are the freaking fees? That's all I want to know. Summary. It's the weirdest thing. These things have fees. I don't understand why they don't show in here. All right. So this looks better. So this goes back, but only goes back to 10 years when they first came out with the Build America bonds. And the reason why this looks better is because two things. Build America bonds were just basically newly issued because of GFC, the global financial crisis. All right, so they're taxable municipal bonds, by the way, taxable. All right, so a couple things happening here. Interest rates have gone down from 2010 till today, so you'll see a price increase. So it's issued at 20, all right, so but you bought it at 20, and right now it's trading at 23.5. So you've made $3.50 per share in your overall appreciation. Hey, it's still appreciating. I mean, what's that? So take my trusty calculator, 3.5 divided by 20. That's a 17% appreciation over the course of 10 years. Nothing wrong. I mean, hey, you still made money. Unlike the other one, you still made money. Nothing wrong with that. All right, so then we go to historical data, and you're still getting, we're going to go to dividend yield. And actually come on, dividend yield. And this one looks a lot better than the other one we had before, because right now it's actually paying more. It's paying 12 cents a share, and it pays quarterly. So 12 cents a share is 12 and a half. That's 25. That's 50 cents a share every year. All right. And when we started, it was only paying 11 something, if memory serves. If we go down here, it's paying 11 something. So it's actually increased its dividend by basically $1 a share. So that's about an 8% increase in dividend. And it's increased its appreciation by 17 cents over the kind of its 17% over the $3. So you've made $1 per share on dividend. No, not $1 per share on dividend. You've made paying 50 cents now. Back then it's paying 40 cents. You've made 10 cents a share on dividend per year, and you've made $3.50 per share on share price. So that's actually proven to be okay. Now, look, man, at the end of the day, what's this going to do in the future with Build American bonds? I don't know. The only thing I'd have going for it, I think, when the yields go down, the interest rates go down, the prices of bonds go up. So if we have a decline in or an increase in interest rates, the price on this will go down. But it's a very unique position. I mean, it's Build American bonds. I mean, they aren't they guaranteed? Are they GO? I don't know. I don't know anything about building. Are they GO, government obligation? I'm not sure. General obligation. But either way, this would be better. But we don't. There's just you're investing in something that's impossible if you know how this works. I wouldn't touch with 10-foot pole. But be that as may, that of the two so far we looked at, this one has definitely done better than the other one for sure. And you can actually look to see financials too, that's what I like about Yahoo. It's easy to see the income statement. Really, what I'm looking for is see how much debt they have, and because some of these will do leverage, and what we want to see is, we got operating expense, so that's the fees right there, the operating expense. So it's costing them. I don't know how you figure that out, frankly, in terms of operating expense, how much that would cost to you as a shareholder. I just don't know. But we go to balance sheet, and I want to see assets, so we got assets, liabilities, and stockholders' equity. So they got whatever that is, 100 million in liabilities and 400 in stockholders' equity. So I don't know what that means. Does that mean they got? Does that mean they're leveraged? 20%? I don't know. But they got $500 as their asset base, of which 400 of that is equity, but 100 of that is in liability. So 20% of that's debt. Does that mean they're leveraged? I don't know. That's the big concern to me. Let's see, free cash flow. If we click on cash flow from operating expense, I just don't see any net income. So I don't know. So I'm not going to read into it. But they got 20% of the portfolio is debt of the assets. I'm not sure I like that. All right, so let's keep going. We're going to go to Gab, and this is the Gabelli Equity Trust right here, and this starts looking pretty ugly too. So we're going to go back to Max. It's been around since 1986, and it's probably issued about probably 10 or so. I don't know. But look, you can see right now it has nothing but flat to drop. So it's basically lost half its value over the last 10 years. Last 5 has lost some value in this portfolio, but it's trading at $5 a share right now. But here's the problem, man. So I was going to show you. So trading at $5 a share. Let me just show you what I'm talking about. So right now it's paying 60 cents a dividend. That's 12.5 cents a quarter. So you're getting 12.5 cents every quarter for the dividend. All right. So if we go to historical data, you're getting. Why do they keep doing that? Please don't give me statistics. I want to hit historical prices. There we go. Dividends only, and we're going to go to Max. Ruby and Max. And so you're getting 15 cents a dividend right now, because it's paying 60 cents a share for each year. Okay, so 60 cents a share divided by the share price, that's $5. Hope that makes sense. Or that's 60 cents per share divided by the share price of $5. It gives you your current yield. All right, but look back. Look, it was paying 16 cents back in 2005, 18 cents back in 2006. 40 cents. Well, that's it. Well, there you go. 29 cents. Look at what the dividend has done. It's gone down. The last 4 years is basically flatline. But I tell you, man, you want growing dividend payouts. And it hasn't had that. So let me show you. So let's look at. What's a good one? Let's look at Exxon Mobil, for instance. We'll look at Exxon Mobil to show you a growing dividend payout. We'll go to historical data. And this is what you want to see. I'm just pulling this out of the air. I could prove myself wrong here. I don't know. Why does it keep clicking on statistics? We're just going to pull historical data, look at dividends, boink. And I'm presuming that 80. Let's go back to. We're going to go back to Max. So it's 87 cents a share right now, and it pays out. Looks like that pays out 4 times a year as well. 82 cents. Yeah, this is what you want. See, we want growing dividends, my friends. So I cannot stress this enough. I've done videos on this before, but right now Exxon Mobil is paying 87 cents a share quarterly. August, November, February, May. It's odd months where they pay it. Fast forward 10 years ago. 10 years ago, it was paying 44 cents a share. I mean, look at that. Fast forward 20 years ago, it was paying 23 cents a share. That's a growing dividend. Your wealth just on dividends alone has quadrupled in Exxon Mobil. With the Gabelli Trust, it's has gone the exact opposite, and the price per share has gone down. I mean, again, if you want to live off income, just buy a freaking annuity, man. I mean, that's, because you're going to get your money back plus a little bit of interest. But you can't. But these things, the problem with these funds is that, as I showed you with the first one, is that the price per share can come out underneath you, and then you turn around and sell it. You only got 75 cents, or you got 75% less than what you put in. All right, let's look at this last one, which is UTF. I have no clue what this is, so let's take a gander. UTF. Cohen and Steers Infrastructure. All right, so let's take a gander. I bet this was issued at $20 a share. So let's see, max. Yeah, in 2004, $20 a share is issued. You've made no appreciation whatsoever in this. None. In 2004, the Exxon Mobil is trading at dividends 22 cents a share. You've quadrupled your dividends in Exxon Mobil, and in this guy, you have had no appreciation at all. So let's take a look at, they're paying 1.86 is their forward dividend rate, 1.86. So let's see a gander what the historical data is. Historical infrastructure fund. Let's go. We're gonna go to max. 1.86 is well, it's what we got here. 0.155. It pays March, April. Okay, cool. It pays monthly. 0.155 is what's paying now. All right, and it was paying 0.155 2018. Whoa. Whoa, 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 whoa. No. Look at this. As I'm seeing point. Whoa, January, March. Okay, they went from. I was gonna say that's nuts. All right, so it's June, September, March. Wait, are they paying quarterly or are they paying monthly? June, May, June, April, May, June, March, April, May, February. Okay, they're paying monthly now. So how did they go from monthly to monthly from quarterly? So they went to quarterly at a special dividend there, it looks like. All right, so then they went quarterly when? Right here. It's got to be. So they went quarterly right here. So they're paying December, March. Okay, there you go. That's more likely. December, March, June, and September. That's typical. So we got back then they were paying 4.4 times 4. They're paying 1.6. All right, so they've increased their dividend a little bit. So I do like to see an increasing dividend. $1.6 a share. Okay, cool. So back in 2016 is $1.6 a share. Let's see what the price was in 2016. Yeah, they've been increasing their dividend. All right, well that's good. I like to see that. That's pretty good. I mean, they've increased their dividend. Well, not much though. Well, hold on before I say that. Look, because here back in 2007, September, October, November, December, 0.133. So it's 0.155 now, but not much. Yeah, that's not. I don't like seeing that, man. I mean, that's okay, but it's gone from they've basically gone from $1.2 a share over the course of a year to 1.86. So we take 1.86 minus 1.2 divided by 1.2. They've increased it by 55%, and that's over freaking 15 years. For Exxon Mobil is quadrupled. That doesn't do it for me, guys. I'm sorry. Yeah, I don't like that. All right, but be it as may, they have increased their dividend per share. All right, so we're going to look at the share price in 2006. Let's see here. So let's look at the share price in 2016. Excuse me, when they had a 1.6% dividend payout. So 2016, we're just going to go over here. September 2154, 1.6 divided by 21.54 at a 7.4% payout. So basically what's happening here is, yeah, I mean, look, you made income, but it's not growing income. A little bit, not much though. I'd much rather see you have something that's. I mean, just look at the difference between Exxon Mobil. I can't stress that enough. Let's look at Apple. Exxon Mobil is a good one. I'm just curious. AAPL, right? Or is it AAPL? Yeah, Apple. Because they started issuing a dividend back in like the early 2000s, if memory serves. So let's see what they're. Right now, they're paying $3.28 a share. Okay, I have no clue what the Apple dividend has done. It keeps going down, so we're gonna. Try to trick me again. I got you, computer. All right, so 77 cents a share is what's paying right now per quarter. And 70. I mean, look at that. Look. Jeez. They had. What's that? That's not even 4 cents. All right, yeah, here we go. All right, so they started paying real dividends back here in 2012. That's what it was. 37 cents a share per quarter, 43 cents, 47, 52, 57, 63, 82. All right, so basically in the last they're paying 82 cents a share now, and they pay it 4 times a year. So they're paying a share of $3.28, which they just told us. All right, so back in 2012, they were paying 37.378 times 4. They're paying 152. They've more than doubled their dividend. So the income you've received in Apple over the course of 8 years has doubled. I forget the share price, just the income. It's a doubling of the income. I just look. This is why I think income investors need to be invested in stocks too. Let's let's look at my BTV. I don't even know if it's showing the ETF here, but let's see. Historical data. So right now we got a dividend yield. I don't even know if it'll give us that or not. Let's see here. We're going to go to historical data. Wait, I want BTV. Hold on a sec. BTV. That's what I want. Value index. I own this, by the way. All right, so let's go here, and we're going to see they got yield 3.11. We could figure that out, but by looking at the price, which is 98.99. Let's just look at historical data. I'm not sure if this will tell us if it pays out or not. Let's see. Dividends only. Let's go back here. Yeah, all right, sweet, it does. We'll go to max. And let's see what we got here. So we had a special dividend there last year. Pays out quarterly. Let's go. Oh, look at, so let's go. The inception of Vanguard Value Trust, or Vanguard Value, 27 cents a share. We're basically looking at 0.3. Yeah, the dividends in December are always higher. So 0.39 plus 0.29 plus 0.26 plus 0.27 equals 1.21. And we'll just look at 2019. So let me write this down, 1.21. 2019 paid 0.735 plus 0.69 plus 0.65 plus 0.9, 2.97. So you've made 250% more on your dividend income from the Vanguard fund. So I mean, just think about that. If we go back to summary and you put $100,000 in here, back here was trading at basically you bought it at 50. All right, so let's just say 50. You bought it at 50. $100,000 at 50. That gives what, 20,000 shares or 2,000 divided by 50. 2,000 shares. So we have 2,000 shares back then, and we were getting $1.21 times 1.21. We made $2,420 of income. All right, so now we have 2,000 shares. We have a hell of a lot more than 2,000 shares because of all the dividend reinvestments, but we're just going to even say we don't reinvest the dividends. We just take it as income. But now we're getting 2.97. So we got 2,000 shares times 2.97. Oops, 2,000 times 2.97. Now we're making $5,900 of income on that $100,000 investment. So now we're a yield on our cost. Yield to cost is 5.94%. Yeah. All right. Anyway, I just thought you might enjoy that. It's I enjoy it. I don't know. I just look, if you shoot for income, I, I inherently don't like income investing because I don't think income investing is stable. A, you're not getting any growth on principal. B, and you might be investing for income that's fleeting, like there's two of those. So of those 4 picks that dude talked about from Forbes, 2 are ugly, man. I mean, they're redhead stepchild ugly. They got beaten with an ugly stick. People actually get offended with, you got beat with an ugly stick. I'm like, whatever. 2 are good. But what happens 10 years from now? I mean, I got no clue. Anyway, all right, hope this helps. We'll see you guys.